Hey, good evening. I'm Dan Fitzpatrick here at StockMarketMentor.com on Wednesday, April 16th. And I had planned on looking at Solar City. I mentioned that the other day, I think just yesterday, that this was actually a pretty good bounce point here, a good buy point. It's up 5%. And I think this support's going to hold. So I think you're going to get a nice run here into earnings, which is on May 5th. But then, and members, I go into a lot more detail on this in the strategy session, but I wanted to share this with everybody. Look, this is a dragonfly doji here. After a big decline, you like to see these types of things where the trend is down, like really down, Google violently so, in really kind of a broadening wedge formation that typically does resolve to the upside by way of a higher low, like we're going to get tomorrow, and then a breakout to the upside. So I think there's a chance for a monster trade here to the long side. At one point, as I'm doing this now, Google's trading at 540. At one point, it was trading in the 520s after hours, which is why I kind of think trading in after hours is only for the stupid people. You don't want to do that. Why? Because nobody else does except stupid people. The stock moves wildly, and trust me, you have no idea what's happening. Do you really? You're in there selling stock at 525 before everybody else sells. Memo to you. You're the last one selling. Now they're all buying. The point is, this is a reliable low. So you can just buy the stock if you want and put your stop a little below there. Put it higher. This is not coming back to see this price. I don't care what you do. Google is not going to come back to test this low. I promise you that. It's just not. That's not the way stocks trade. Not after a big reversal. Doji like this, a dragonfly doji, which reflects an intraday reversal. It closed back near the top of the daily range. This is a really meaningful pattern, much more so than this. Sure, it was an intraday reversal too, but the stock closed still like in the lower half of the range. You don't see these things very often. Here, I guess you got kind of a similar thing, and look what that led to. But the decline wasn't that steep. You know, it was fairly orderly, but even this one worked. So now we've got this, where the stock goes from 610, you know, down ultimately to about 520, I think it was. You know, that's a 90-point drop, and most people trade this using options. I don't buy a $610 stock. I buy call options or put options on it. Most other people do too. Remember when it was trading for twice this before the 2-for-1 split? That was options heaven, baby. So anyway, the point is, you can go ahead and buy this stock at the open. I think you're going to make money. If you're an option trader, here's what I'm going to be doing. I'm going to do a wimpy trade. Okay, the low here was 518. I'm going to be selling some 520 puts. I'll do it in a spread so I don't have to use a boatload of margin where I just sell naked puts, which is the equivalent of, you know, obligating yourself to buy, you know, however many contracts you have times 100, that many shares. So if you sell 10 contracts, means you're going to buy 1,000 shares of Google at $520. I don't know about you, but that's a little above my pay grade. So I'll go ahead and sell some 520 puts, and then I'll buy probably some 510 puts, and this is in May. The contract expires in 30 days. So there's going to be a lot of erosion of the time value of your options. And since they're out of the money, it's all time, baby. So every day, the dollar amount of your options that you sold erodes. We like that because when we sell an option as opposed to buy it, we sell an option and then that option starts losing value. That's known as a good thing. So I'll be looking to sell the May 520 puts, buy, say, the 510s, maybe the 500s, I don't know, probably the 500s just because I want to get more dough for my mo. And then in a couple days into next week, I'll probably close that position out. But these are the types of trades that you can make on this volatility. I have a long call position in the by means of a bull put spread, a long-term January, not bull put spread, a bull call spread, a long-term January bull call spread. The 550s, I think I sold the 600s. So that'll be down tomorrow. So what I'll do is I will be buying back the $600 calls that I sold for a really, really nice profit. I will be more upside down on my long 550 calls. That's a drag. But the 600s that I sold are mitigating the damage to the $500 and 50 cent or the 550s contracts. So I've effectively lowered my cost basis by selling these. I've lowered my cost basis in the 550s, which means that the drop in value of the 550s between between today and tomorrow, Thursday, is less. The loss is lessened because I hedged. This is just a pure hedge, is all it is. I'm kind of bummed because I was hoping the stock would stay down here at about 525 or so, because then the sale of these would be much more profitable. I knew this stock was going to snap back from 525. I mean, if you follow stocks dynamically, you knew this stock was going to snap back. But the fact that it did it, after hours is, again, I'm kind of bummed. It sounds probably weird that I would be bummed when a stock is moving in the direction that I wanted it to, but on these after-hour moves, what you're really trading is the rubber band. That's really what you're trading. You want to be trading a rubber band that is stretched so tight that when the opening bell rings, that thing snaps back big. Well, it's still going to be stretched kind of tight tomorrow if it opens up around 540, which is where it is right now, but not as tight as it would have been if it was 525. So tomorrow the trade is definitely to the long side. However you're going to do it, whether you're buying stock, whether you're buying calls, whether you're selling puts, whether you're buying a spread. There's a lot of different ways you can play it, but just know that trading after hours, and you can quote me on this, everybody else does, is stupid. It's just dumb. Don't do it. I guarantee you that if you've been doing it, you haven't been making money. You'll make the occasional buck here and there, but is it really worth it? I don't think so. So trade during the open hours. It's when everybody else does. It's a lot of fun. Okay, so do that, but be long on Google. Take advantage of this and learn to recognize these dragonfly dojis. They have a real good description of what a dragonfly doji is over on stockcharts.com. It's free. You can check that out. They're a really good resource for a lot of trading definitions and stuff like that. So anyway, I hope this helps, and don't forget about Solar City. That's working too. Okay, members, over to the strategy session. Lots of stuff to do. Oh, and by the way, I almost forgot to tell you, if you are not a member of Option Market Mentor, check it out. You get a free 30-day trial. And the thing is, right now, we're not always this way, not at all, but right now we're 12 for 12. All of our open option trades are making money. And in this kind of volatile market, that's something that I'm proud of. Full disclosure, nobody else will tell you this stuff because they're trying to hoodwink you. I'm just trying to help you make money and make a little myself in the process through subscription fees. Sorry, I don't work for free. But sometimes our options don't do that well. It just kind of depends. But right now, they're doing really well. And I've put on a couple more option trades today. And I really want to see you over there. And if you do trade options already, you're going to see a rockin' forum. I mean, there are some really, really good traders in there that are selling a lot of puts, doing a lot of spreads, doing weekly options. Kind of tough for me to keep track of all of them, but it's a monster product, and you can try it for 30 days. No harm, no foul, no questions asked. Check it out. If you don't do that, you're probably trading in the after hours too, okay?